Monday, the 24th of July. So we're getting through the summer, pushing right through. And well, let me see. So it is, oh gosh, it's 8:30 a.m. EST. Market open happens in 30 minutes. And I just figured we'd go over some basic stuff today. I had one of our, uh, hold on a minute. I got something funky going on. Hold on a minute. There's something funky with my stream. Let's see what's going on with this. I got something funny going on here. You know what? I might have to stop this stream. Let me see what's going on here. Oh, nope. Okay. Sorry. I totally ended the stream for my private viewers. Didn't have to do that. Sorry for the weird beginning of the show. Let me go ahead and restart that. All right. Hopefully this ports over again. Anyhow, so after that very odd start to the show, today we're going to talk about support and resistance. But just a quick reminder, nothing we say on here is going to be, not to be construed as like investment advice. Everything we do is all for educational purposes only. What we do here is we help people, first of all, we help them learn how to trade, just like just how to trade. Nothing terribly fancy about that. We do teach people how to build algorithms. We teach them how to do that. And of course, building algorithms is really something that is a lot of people get scared of it. They think, oh man, it's, I got to learn how to code and do all this and that and the other. It's not true. An algorithm is simply just like creating a methodology for trading. Anybody who's traded successfully has traded using an algorithm, whether they know that or not. I like to say, tying shoes is an algorithm. Anything that is a process where you have, if these conditions line up, then you make these decisions. That's an algorithm. Driving to the store is an algorithm. So if you learn how to trade and learn how to trade successfully, then what you're doing, I would say 999 times out of 100, is you are using some form of algorithm, whether you know it or not. So we help people just become traders, and then once they get to a certain point, and they are good enough traders, then they have like some good algorithms. They've tested them, they know that they work, and they're comfortable investing a little bit of money into coding them. Then we can go ahead and refer you over to a coder. Now, normally that's going to cost like thousands of dollars to do. Well, close to like 5,000 or 6,000, anywhere from that up to like maybe 10,000 to have something coded, and that way you can basically have it automatically trade for you, in the background while you just go about your day. And we can have that done at quite a bit of discount at that price. So we haven't gotten anybody to the point yet who is ready for that. Although we do have a lot of people that are deep into back testing, over 100 back tests. We actually it's about 200 back tests by the time you're ready to live test. And long story short, I think we'll have some people ready for coding after not too long, and that's super, super exciting. Okay, so but understand that this is not like a get rich quick scheme. It's not some kind of a thing where it's not like some kind of a where you hop on and you make money right away. And this is like an education. This is an investment of your time. This is a marathon, not a sprint. So don't sign up with us thinking that all of a sudden you're going to make money next week. It's unless you're already a trader and you work extremely quickly. I'm not sure that we're going to be able to promise that to you, but if you do work hard enough and you apply yourself, then the chances are pretty high you'll be able to create yourself an income stream. And even if you want to keep your job, one day you could still like even increase your income. There's a lot of people who like their job. They don't, want to leave it. And there are those out there who actually think that it's a good idea to keep your job and not lose that income stream for trading, because there's some psychological components to, knowing that your regular income is there. Some people believe that can actually help you trade better. That's not necessarily the show today, though. It's just kind of a brief introduction to what we do. What I will do, though, is before we get too far, I'm going to throw the URL up in the chat. That's www.algofactory.tech. And let me go ahead and put that up there. And as you can tell, the grill is not here today. He actually is not feeling well. So he is a little under the weather, unfortunately. So with that being the case, Cowboy's going to handle it all today, and that's all right. Just not too often that V doesn't feel well. It's actually kind of rare. That's where it is, and it happens to all of us. So he's going to take today off, and that'll also be the case for his regular shows, as I did tell everybody in the Rogue Discord. Either way, though, there is the URL, and I'm going to throw a QR code up as well. That way you can just use your phone or your QR code reader to zap that, and it'll take you over to the website, and you can take a look at what we do. And we have a full course group of courses on there. So you just go through those at your own leisure. And of course, we have a Telegram room where you can go in there, ask questions. We're on there all the time. I'm in there, all weird hours of the night working and stuff, because as a trader, that's just how I roll. So that being the case, I'm going to move on. We're going to actually move into the content. We're going to talk about support and resistance today. We had Brand, who is a new member of the private group, and he did have some questions about support and resistance. So we are going to go ahead and talk about that. Let me bring up some charts here. Let's see. Let me add share screen, entire screen. Okay. So support resistance is actually it's a pretty simple concept, okay? The way to recognize and support resistance from a pure price action standpoint is going to have to do with looking at the chart itself and seeing where a lot of transactions happen in the past. And there's pivot points, and then there's order blocks, okay? So first we'll talk about pivot points. And what I do is, you're looking at a screen right now, and you can see there are 3 different charts on there. And this is actually one chart. It's just split into 3 different time frames. I've got the 3-hour time frame. I'm going to move this up to, say, we'll say the 18-hour. We'll move the middle one to the 3-hour, and the bottom one will move to the 30-minute. So this is kind of more like what somebody would look at, the 18 hours, like the daily, that kind of thing. All right. Because what most traders are going to do is they're going to look at the daily time frame for sort of what's the high, time frame, what's going on, like on the higher time frame bias, right? And then the middle time frame is going to be where a lot of people are actually trading. And then the lower time frame is what people are going to use for their entries. And that is not what we're really here to talk about today, but that's maybe a little more advanced than we need to talk about. But we're going to talk about support and resistance and how it matters. So support and resistance is basically where price turns around. So it tends to be, price will like kind of bounce off of a support, and price will reject, if you will, at a resistance. And so it's all kind of looked at as structure. So an easy way to look at it is pivot points, right? So a recent pivot point where price turned direction is going to be like right there. You can see how price moved up and then came down, and that's a pivot point. Okay. So there's a decent chance where price, if it goes back up to that area, is going to turn around again, because that's just how things work. For example, you have right here, this spot where price came down and then turned around and went back up. It tried to come back down again, and it turned around and went back up again. And it happened right after that. And you can see that happens throughout charting. Here's another example where price came up to this point, turned around and headed down, and yet it did it again right there. So this is another example of a pivot point. And so pivot points are a decent way to just kind of eyeball support and resistance. And there are a lot of traders that, all they do is look at price action, support, resistance. They don't even really use, and they'll use candle theory, right? They'll use patterns that these candles make. And they'll use those to kind of determine what's going to happen, because the Japanese candles are designed to tell a story. We're not going to talk about candle theory today, but I am going to just kind of demonstrate support and resistance on these candles. So, you got some kind of minor areas of support and resistance, such as this one that I'll draw out right here, price kind of bouncing off the same thing twice. And then you have some kind of more major stuff. For example, if I go way back in time, you'll notice that price bounced off of here. And if you extend that way out to the future, you'll see that it more or less bounced off that same area again right there. So pivot points are a good place to look for support and resistance. And there's another concept in there called order blocks. Okay. So, but thinking of it this way, going back to simple pivot points, if you think about it, these are really simple ways to determine, what is going to happen in the future. Like you have a major pivot point on a high time frame, right? And you could do this on a lower time frame, but major pivot points in the past tend to act like major pivot points in the future. And you can use kind of minor ones as potential rejection points too, because look at this. You have this kind of larger move down this way, right? And then you have this move up and there's a rejection right there. Now there were some smaller kind of lower time frame rejections on the way down as price was headed down, and it tried to rally up and it got rejected at a few different areas. Well, this is one area where price got rejected right there where those arrows are. And that actually has extended further into the future, and it seems like, well, it rejected right there again, right? And if you line some of these kind of lesser rejections out, you might find that price may reject there again. But what is important to know is that this older structure really stops mattering as much once it's covered up by new structure. What does that mean? Well, you could call this, there's one really good trader that calls it inside and outside structure. And I think what he means by that is, so these pivot points back here got covered up by this price action. And when price went back down, all this price action is now blocking these pivot points. And this is outside and this is inside. If I remember, that's how he says it properly. I don't want to like kind of jack somebody else's, terminology, but it's just, it's kind of an easy way to explain it. So the new price action that is kind of outside of this move up is sort of taking away the importance of this old price action. It doesn't completely take it away, but it makes it a little less relevant. So the more relevant price action for what's going to happen in the future is going to matter what is on the outside of any recent price action. So for example, if price were to continue to head down, right, any of these little pivot points along here are going to matter. They're going to act as sort of, not necessarily, but they have a decent probability of acting as some sort of support on the way down, especially this little double bottom. It wouldn't surprise me. Even here, like this area right there, that did seem to act somewhat as a support on the way down because price kind of bounced off that area and headed back up right there, you see. So in this area, this price action with these two arrows was not blocked by any other price action. So this is what would be, I think, again, considered outside, if you want to call it that. We'll say it's more relevant price action because it's not blocked by anything. If, for example, let's just pretend for a moment that the price had, gone down here. Where's my arrow? The price had, instead of going up like this, the price had actually gone down and then gone up and then gone down like that. Well, this price action would have covered these up and just made it a little bit less relevant, right? So, addressing the probability of those is going to have to do with a lot of back testing and things like that. It's almost easier to simply sort of notate that it's, relevant or non-relevant structure and just kind of move on from there. And then, if you're using algorithms, then, which this is what we do, if you're kind of using indicators and stacking them, you might have the opportunity to say, okay, well, this might not be as relevant of structure. However, my algorithms do say there might be like a bounce coming here. So even though it's not as relevant, it's still there, it still matters. And the algos are telling me it's going to move. So in that case, it might be, hey, all right, actually I'll use this because the algos say price is going to move, even though it's less relevant, it's still there, right? For example, on that point, if you will, you have these two pivot points where price actually kind of, it moved up and rejected and moved back down, right? And then it moved up and moved back down. Well, these two pivot points arguably can sort of, they may have made some structure that formed the basis for these next two moves, where I will place arrows momentarily. So this bounce and that bounce may have occurred because of this structure right here. So one way to kind of think about this and why this might be kind of happening is because it's like a history of what buyers and sellers were doing. So we want to take a peek into the psychology of why these pivot points are probably working from a psychological standpoint. You got a lot of people out there that are just, buying and trading, and they're not necessarily paying a lot of attention to, indicators or, all these other concepts that us technical traders do, we sort of now take for granted. A lot of people are just looking at the price, and that's just a common thing. And it's going to depend on your market. Really, how many people are paying attention to, simple price and all that. I'd imagine that maybe some very well-known equities are going to have more people paying attention to price, but are those people a small piece of the pie? And you start getting into some statistical weeds, and it almost doesn't really matter. What does matter is how you test. And what you can do with back testing is you can determine, okay, well, how much do these pivot points matter for this stock or for, this currency pair? And you can really sort of test. If you're simply testing pivot points, you can do the math. You can go back, you can look at, okay, how many times did price react at this pivot point in the future? And you can test that way. But in the meantime, it's kind of really good to just have a basic concept of support and resistance. And I think that one way to do that is to think about the buyer's frame of mind, right? So let's say at the beginning of the year, right here at 2023, I'm just gonna make up a story. Doesn't mean it's true, but I'm sure it's at least partially true. January tends to be a bit of a weak month. Now, this is the dollar yen, so we're not really talking about like stocks or anything. But at this point, we're just gonna say the dollar was like getting weaker, and then people started buying, and the price started going up. So more people started buying, and the price was going up, and so a lot more people started buying, and the price kept going up. Right? You got a lot of people who are just looking at the price, so they're gonna buy, and the price goes up, and then right here, price headed down. Maybe for technical reasons, maybe it had to do something with the market, whatever the reason is, price made a pivot point, right? It could be that back here, when the price made all these little kind of attempts to go above and got rejected, there were a lot of people who they had bought before and price was heading down, right? And so as price was heading up, they decided to get out of the trade because they're like, oh, I need to get out of this. Like, it's just not going that well. But we got a little bit of a gain, so I'm just going to get out of here. And they got out of the trade 1, 2, 3 times. And so a lot of activity happened with people either getting out or taking profit on shorts, one of the two. And so because that activity happened right here, there are going to be people who are like underwater from their trades. And so all of a sudden, those people who are underwater, now the price starts to go back up, and they're like, okay, it's getting better. Okay, now I'm at break even, right? They're like, okay, I bought right here. Price is falling. It's at break even. I can get out now because this thing's trouble. I think it's going to keep going down. And they get out because they get to be at break even, right? And then there's other people who bought right here, right? And then the price goes against them. But then again, the price goes back up, and they're okay, I can get out. Let's get out of break even. Bam, it gets out of break even. That's the fear side. So that's the fear side of what's going on, right? That's like, oh, I need to get out of this, break even. Now there's also the greed side, because everything's fear and greed in markets. And the greed side is maybe you had some people who bought right here and they made money and they just got out right here because they're technical, whatever. Maybe their profit point was hit. Maybe they just, for whatever reason, they got out here, and then price went down again. They're like, oh man, I could buy again because I bought around the same area and I made good money, and I think price is going to go back up. So they buy again, and the price goes up. And then they get out at that same area again because, hey, that's that same area I got out before and I made money, so I'm going to do it again, right? So that's the greed side of things. So this is psychologically, part of the reason why a lot of people are getting in and out on these pivot points. And of course, you have like a lot of technical traders such as us. We'll use pivot points just as a way to get out. We'll use them as a resistance. We say, hey, price pivoted right here. There's a decent chance that it's going to turn again, so we're going to get out before that. It could be algorithms that are using pivot points. There's a lot of reasons why technical traders will get out at that spot. So you're combining sort of this psychological and technical situation that almost you wonder if it's a self-fulfilling prophecy. And I'm sure in many ways it is, in many ways it's not. That's what's impossible to really know without understanding the minds of every single trader out there. But what we know is that price moves at these points. Okay. So these are supports and resistances. And I think Brand in the chat mentioned like he sees kind of these candles all sort of gathering up in the same area. His actual question was, it's like, hey, is it possible to teach us how to how to identify market structure correctly? It seems like everything looks like market structure if the candles congregate for a certain period of time. And I mean, that is a good observation. And that tends to be the case. So when candles congregate, he's saying that creates market structure, which is support and resistance is a market structure. And so when you have these pivot points, there tends to be a bit of a congregation, but then there's also oftentimes at these pivot points, you're going to see a congregation because you have something called accumulation and distribution. Okay. So when he means congregation, I think what he's referring to is sort of this higher time frame, candles kind of in the same area like this, and also like that. And if you look into the future, that's going to create support, right? Like possibly, we don't know because it hasn't gone back there. But if we go way back in time, we can see how, for example, these candles congregated right there, as price moved into the future, it bounced off that a number of times. It bounced off it, I should say, like say here, there, very violently right there, with a lot of energy right there, and dipped into this area and bounced up, and then again really rallied off that and made a whole new move up. So this is basically, it's an order block. And so a lot of people in the trading world feel that the order block is where candles are going to bounce. But I don't, what's actually seems to be happening here from what I can gather is that price is actually attracted to these areas to gather liquidity. That's what that's about. So it will effectively create a structure, but it's only because price is attracted to this. And once liquidity is gathered, price will move on to the next area where liquidity can be gathered, right? So for example, there was a lot of liquidity built right here. And then of course you had, I'm sure if you go in the past, we'll find that a lot of liquidity was also built in this area. So you had this liquidity that was built in here as well, right? And maybe even a little bit down below that. So as price went above this area, it created what's called which you could call a demand zone. I know a lot of people in Forex don't like to use the term supply and demand, but it creates an area where there was a lot of transactions. And as we talked about before, these kind of pivot points, especially where a lot of people did transactions, you're going to have a lot of people who have that psychological, either it's a fear thing where they're getting out of a trade, or it's a greed thing where they're getting into a trade. And as price reapproaches that area, that fear and that greed is going to kick in. And so that's going to be called a demand zone. And if it's up high, it tends to be called a supply zone. So as price, for example, there was volume created down here. Price moved up, and then there were a lot of transactions, people getting in and out of trades, and then it moved back down towards where all this volume was created before. So, however, this area where all this happened created a new liquidity zone, and price actually tried to rally back up and did into that liquidity zone, this supply area, and it gathered whatever supply it needed, and then it headed actually back down to the demand zone. And then this area, in turn, created a new supply zone, which was tapped once again right here, right? And then price moved back down to that same demand zone. And then yet again, this action right here created a new lower demand zone where price rallied up into that. And once the demand was gathered, it rallied back down to the stronger demand zone. And then we have that repeating and repeating and repeating until this demand zone is kind of eaten up, if you will, and then price rallies to the new spot. And I guarantee you, if I go way back, I will find some price action that's way up high where price, wanted to go back up to that. No, we're going way back to like the beginning of time. And, so there's going to be market discovery up here because price never went up there. So, but long story short, that's how things work. You have these little areas of where price action, where candles congregated, and those are just liquidity areas. The price is going to be attracted to those. And once the liquidity is drained, the price is going to generally resume the direction it was at before, and it's going to be attracted to a new demand zone. Now, in this case, you can't, this pair was not, it didn't exist or it wasn't on this chart. So we can't tell if moving up to this area is going towards a demand or a supply zone from way back in the past, or if that didn't exist and this is price discovery. And of course, price discovery is when an asset goes into a totally new area and starts to develop new, new demand zones and new supply zones based on, just based on whatever the market wants to do, a lot based on market forces, based on a lot of technical stuff. However, one thing to also know is that there are accumulations and distributions. It's another way to talk about these zones. So price here, buyers were accumulating the dollar against the yen, and then price headed up. And then you don't know, as these candles congregate, we don't know if it's going to be an accumulation or a distribution until afterwards. And it turns out to be a mini accumulation zone because price did rally up into the next area. And then, of course, you have this sort of this accumulation, and it appears to be like a distribution because price kind of heads down and it taps this liquidity. So you technically could call it sort of this, I don't know, weird accumulation distribution combo, because then it accumulates and heads up even higher. And then price ends up way up here, right? And as it is up here, you see candles, again, they congregate, which is called like they range. The price kind of ranges out for a while. And then a lot of distribution happens because overall people are selling as opposed to buying the dollar against the yen, and then price heads down and starts to create a new area. And this, of course, ends up, we don't know until afterwards, but it ends up being an accumulation, and the price heads up, and this is the cycle over and over and over. I'd say this kind of covers the it just covers sort of the basic idea of why candles congregate. Today we also cover the psychological reasons why people will either buy and sell. Usually has to do with what happened in the past, whether they are greedy or fearful. And most of the time price is going to be attracted to these zones, not bounce off of them. And that's one thing that is very, very commonly misunderstood in the market, in my opinion, right? Just my opinion. But it seems to me that from what I've gathered and from a lot of the actual, the institutional traders that I personally, the big time real dog traders that I've worked with, their opinion is such that these zones are their liquidity to which price is attracted, and then price leaves. So it's not like it bounces off of here. Now, there are areas that price will bounce off of, and usually that's where there's not very much liquidity at all. And we do have an indicator that can kind of map that out, but we're not going to share that here because that's an Algo Factory thing. But if you want to know more about how we kind of map those out, some of the indicators that we use, then you can always head over to www.algofactory.tech. Come check us out. We're extremely inexpensive, at least for now. The price will eventually change, but for now we're $49.99 a month, which is an incredible deal for what we're offering. Any competition we have is like 6 times as much. I've looked into it, so we priced this to bring people in to just kind of give us a chance, just that kind of thing. So just take your time, enjoy, and if you have any questions, also let us know. You can contact us through the website at the Contact Us button. And that's that. So I'm gonna head over to the private group. I don't have the gorilla to give us that send off, so I'm gonna do it, and we'll catch you guys mañana, every day here, free beginner course, and that's at 8:30 EST. All right, stand by, private group. Okay, let's see here.